Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I am such a pleasure to be joined by Percy Nikora. Percy, welcome to the podcast.
Thanks, Whitney. I've been a fan for a great time, so excited to be here.
Awesome. Well, I know we were talking before the show. You have a property called Creekside at Athens, 98 units in Huntsville, Alabama. But before we dive into those details, tell us a little bit about yourself, how you got into multifamily real estate and where you're at today.
Okay. It's a little bit of a windy story, but I'll keep it short. Many years ago, my background is in tech. I sold a tech company, started to just diversify my portfolio. Real estate was a part of that, was also doing a lot of other startup investing, angel investing. But over time, I noticed that real estate was giving the best risk-adjusted returns. So my portfolio and percentage allocation in real estate started to grow, initially single family. Then as we all have experience, it's a little hard to scale single family. So moved to multifamily, invested with a couple sponsors as an LP, and then ultimately came on the GP side about 7 years ago.
Well, I so many people listening to the podcast can really identify with that story. So thank you so much for sharing. Well, let's dive into the details.
Sure.
So we got Creekside at Athens, 98 units in Huntsville, Alabama. Let's just go over basic details. What was the purchase price and when did it close?
Yep, the purchase price was just over 22, almost 23 million, with all the closing expenses, etc. We're just around 25 million, and this was April of 2023.
Very recently. Well, we know that you got to back up the timeline here a little bit. So tell us about when you found the property and how did you find it? Was it on market, off market? Tell us a little bit about the class of the property and your overarching business plan.
Yep. So this is a build to rent community. Some of your viewers might be familiar with that asset class. These are essentially almost like single family houses, but in a community, right, all together. And this particular property also came with 10 acres of land on which we could build an additional 120 units. And it's right outside of Huntsville, Alabama. Well, that's seeing a lot of job growth, population growth. So it's a good market where we've been in that market. We have a property management team that we're vertically integrated. So we have our own property managers and we had a footprint already in that market. So we're pretty well known in the Huntsville area. So I'd like to say we see all the deals, but if not, we at least see 95% of the deals that come to us off market. And this one was sort of in that arena. It was through one of the large brokerages, but we've transacted with them before. We bought this, it's a 2021 construction. So it's, in terms of multifamily, it's almost new, right? And we were able to buy it at a 6 cap, which is a pretty good discount compared to where the market was at that time. And we bought it straight from the builder. And to be honest, we were not the highest bidder on that particular project, but the seller wanted surety of close. And since we've done seven or eight projects in the Huntsville area, we were, given the project because they knew that if we committed to it, we would close on that particular project. So that's how we were able to put it under contract. I'm sure we'll touch on this, but it was at an interesting time. I think it was around late 2022, maybe end of 2022, that we put it under contract. And then at that time, the capital markets were in flux, right? So that was the other reason why the seller wanted some assurance that we could close on the property. And that was part of it. It was an exciting time because we were trying to negotiate with our lenders and get the best deals when the interest rates were on a rapid rise. And at the same time, LPs were a bit nervous and sitting on the sidelines. So the timing for this particular project made it exciting. It's not the largest property in our portfolio. It's actually on the smaller side. But even so, it made for an interesting deal.
Very interesting. So you put under contract late 2022 for about 22.5 to 23 million,
Yeah.
25 million all in. Capital markets are moving on you. You've got low investor sentiment or nervous investor sentiment.
Yes.
But how did you find the deal? Was it brought to you? You bought it direct from a developer. Was it brought to you by a realtor?
It was to a broker. One of the large brokerages did bring it. It was, call it partially marketed, not completely off market. Not, is there really such a thing as completely off market? I don't think so. The brokers always shop it around to their preferred buyers. So I think we were lucky enough to be on that list. And so we did see the deal. That particular, we've sold the property through that brokerage as well. So we know the broker. So they knew that we could perform on that property. We've have a nice portfolio in Huntsville. So they we're well known there. So luckily we were able to have the right contacts, see the property. But like I said, I'm sure other people saw it as well, because we were not the only offer that the seller had, and we were not the highest offer. But
yeah, how many other people were you competing with? Do you know?
It's hard to tell, but I know at least probably, if I had to guess, I'd say maybe a half a dozen groups probably were bidding on that project.
And so how did you structure the deal in such a way that the seller knew you were going to close?
Yeah,
so how did they you?
Right. So a couple of things. One is just showing our history and the transactions that we closed, even in the last, I guess from that point, even in 2022, we had, I think, 3 or 4 deals go full cycle. So we were able to show that. We were able to show, we had just recently launched a fund as well. So we had some commitments in the fund. So we were able to show that, look, we have equity, or we have the commitments for the equity. We just have to call the capital. And again, having done quite a few projects there, we have about 1,200 units in the Huntsville area. We were pretty well established, at least in that market, right? And there's only a handful of markets that we focus on. So we've been in Huntsville since 2019. So we've been there for a couple of years now.
Okay, but how did you structure the deal? Did you say we're going to do 30-day due diligence, 30-day close, and a couple 30-day extensions? How did that all get packaged?
Yeah, our typical deal that we go into, we did have to put down I'd say a sizable non-refundable deposit, because we knew about the deal. We knew it's a new bill. We knew about the area, so we did have to put down a decent let's say money going hard right up front, with some contingencies on title and environmental, etc. But then after that, we have 30 days for due diligence. And then we had 60 days to close the property after that. So in total, we had about 90 days sort of all in. And I think we were right around that time. I think there were we went for agency debt, which tends to take a little bit longer. So, we might have extended it by a week, I think, outside that overall 90-day window, and the seller was fine with that.
So you didn't have any built-in extensions. You just
we do tend to put built-in extensions. At that time the market was so competitive that they don't want it, right? So we might have had a built-in extension. We would have to pay extra to get an additional 30-day extension.
And so how much did you put for hard money down?
On that project, it was $500,000.
$500,000. Okay. All right. So $500,000 hard from day one, 30 days due diligence. Talk to us. How did due diligence go? And let's start with the physical due diligence. Right.
Well, luckily, since we have a team based in Huntsville, we were able to knock that out, I think, within a day and a half. So we generally we split the team in 2. So during the actual site visit, we have part of our leasing team conducting an audit on all the leases, making sure that matches the records and everything. So the leases look good. And then we have our sort of construction management folks walking each unit. And then we use software to track what any issues with at each unit, we take pictures so we know going into the property what renovations might need to happen. If we need to either fix something or even make certain upgrades, we have a good record of that, or at least a snapshot of that prior to closing. And then we use that information to come up with our budget. So when we do as we're refining our underwriting, we use that information to say, oh, 5 units here need new cabinets, for example, which we may not have initially envisioned. So we take that into account. We come up with our budget. We roll that into our renovation plan. We know when we're going to be updating those units. So we try to dial it in and hone our underwriting as we collect this information.
Okay, so on the due diligence for this particular property, it was a 2021 build, 98 units. Sounds like you guys knocked it out in a day and a half.
Yeah.
What did you find? Like how did that go?
Overall, I'd say it went fairly well. There were maybe 2 or 3 units where some of the cabinets were maybe not treated the best. So they had a little more damage on them than we would have liked to see. So we plan to replace some of like cabinets in 2 units. We checked, there were a couple of plumbing leaks. So one of the things we also look at the prior work order history. And in looking at that, we had noticed some plumbing fixture leaks, etc. So we checked into that, made sure that's not going to be an issue. And it seems to be just sort of one-offs. We also look at what amenities the property has. So they had a pretty good pool, they had pretty good clubhouse, a nice sunroom, a computer room. So the amenities were fine, but we were looking at, okay, what additional value we can offer. So we're actually looking into putting like a pickleball court or something like that, which the tenants might enjoy a little bit more. So that kind of planning happens at that stage as well. We try to map out where we can put that. We might add an additional, there's already one dog park, but we might add an additional dog park and things of that nature.
Okay, so it sounds like the overall physical due diligence of the property went really well. You identified some opportunities to where you can add additional amenities, which is always amazing as part of the business plan. Let's talk about the financial due diligence. Since this is a build-to-rent community pretty recently, occupied and by the developer, what kind of financials did you have? How did that go?
Yeah, so one of the things, because the property was completed at the end of 21, they had just started to lease up the units in 22. So generally when you're leasing up these units, or it's not uncommon to see some concessions being provided, right? So the rents were already, I would say, $150, $200 below market. Now, part of that is recognizing that because we own and operate, the properties in a market where the rents have been growing pretty rapidly, and if you're not on top of it, then it's very easy to sort of fall back. So we already knew the rents were below market, and then we had an additional plan on adding services for the clients. For example, offering high-speed internet at a price that's at a discount than what the residents can get by themselves. But we buy it in bulk, so we get a discount, and we essentially put a small markup and offer that to the residents. And all of that goes straight to our bottom line, right? So there were additional things we were looking at, saying, okay, what are the financials today? What does that equate to for a cap rate? And then what are the things that we can do? And in both those scenarios, this property seemed to do fairly well in that we knew the existing rents, even if we kept it where they were already under market. And then on top of that, we can apply our business plan and increase the rents even more. And so it's been about I'd say, close to 4 months now since we purchased the property, and we're actually seeing that in action, and it's actually a little ahead of our projections, and we've already started making distributions on the property.
Awesome. Okay, good to know. Good to know. Well, let's pivot to the financing, because you said that this was little bit of a nut to crack, so to speak. So agency debt, let's get into the specifics, fixed rate debt, interest only, give us all the nuts and bolts of the debt structure.
Yep. So I guess the first task, obviously, as soon as we put it under contract, is to start getting some, get the financials from the seller, start putting our business plan together, and then start shopping for with the lenders, right, and try to get the best deal we can. And obviously, we approached the different agencies, Fannie, Freddie, but there were also some bridge players who wanted to have different products that wanted us to evaluate their offering. But ultimately, we wanted given that the interest rates were going up and we knew they would continue to go up, we wanted fixed rate debt. So we decided to go, and everybody was coming back with their proposals, but at the end of the day, Fannie Mae gave us the best terms. And so we got, what was interesting was tracking the rate, right? Because even with Fannie Mae, it's a fixed rate debt, but it fixes at a point when you lock in the rate. And that generally doesn't happen until you get pretty close to closing, or maybe a month before closing. So every day we would nervously look at the interest rates, and one day it would be at that time, I think it was like 5.5%, and then it would jump, the very next week it might go up to 6%. And then so there was a bit of a, roller coaster with the rates, and we would have to update our underwriting, change our projections for our investors. So we told them, look, we are anticipating a rate between 5.5 and 5.75, but there were certain days when the rates were over 6.25. So luckily, the rates then came down a little bit right before we closed. We locked it in immediately, and we were able to get a 5.6% fixed rate debt for 7 years on this property. And the other reason we went with Fannie Mae is they actually liked this property and the financials, and were able to give us 65% loan to value, which a lot of lenders at that time were looking more around 60%, or they were more comfortable in the 60% range. So Fannie Mae went to 65% and 35-year amortization. So all in all, they gave us $15 million in debt for this property.
Okay, is it non-recourse debt?
Yeah, it's
okay.
all of our deals are pretty much non-recourse, but an agency tends to be non-recourse. If there was a construction component that may have some limited, recourse caveats built in, but it's a cash flowing property. It was stabilized already. We were just sort of improving the NOI.
And is there any sort of prepayment penalty or lockout period?
So I believe in this loan, it steps down. So after year 3, it comes down to like a 1% exit fee, if you will, and that's fairly common. And if I recall, it may even go away after year 5.
Okay, awesome. All right, so you get $15 million in debt. You're all in at 25. I'm assuming you bridged the gap by raising capital. Is that true?
Yeah. So the breakdown of the remainder is that we got $6 million in LP equity, if you will, common equity, and then we brought in. We have relationships with some preferred or pref providers, so they provided $4 million in pref. So we got the other $10 million covered through that.
Well, tell us how you structured all that, right? So, the capital stack, is essentially the senior debt, the pref equity, and then the common equity. But how did you structure the returns and the pref equity and the common equity position?
Yep. So we have the senior loan, which is the agency debt or the Fannie Mae debt, which is $15 million. And then that $4 million, which is the preferred equity. So that it gets a little complicated, but essentially there's a certain percentage that is paid current, and then the rest of it that gets deferred. So these days, depending on where the market is, that changes a little bit, but you're looking at somewhere around, paying 7 or 8% current, and they cap out around 12 to 13% in that range. And again, there are different pref players that have a preference on some write smaller checks, some like larger checks. In our projects, we have pref players all the way from, I think the 4 million is probably on the smaller side, to 12.5 million or so. So it really depends on the players and what their appetite is, but it's generally in that range is what they like to see from a return standpoint. The benefit to our LPs is that once you go over that hurdle of 12 or 13%, all of the remaining profit, if you will, goes to the LPs. So that was able to boost the returns for our LPs. And on this particular project, we are, it's a projection, but we are projecting 24% average annual return to the LPs. And part of the reason for that is by putting that pref in place and letting the excess profits go into the go over to the LPs, they get a nice return as well. So I hope that made sense.
Yeah. So, and just to kind of recap that for listeners, and I do want to dive in a little bit more to the LP side.
Mm-hmm.
It seems like you're paying current 7%. Let's just,
Yeah,
and you
correct.
can correct me on
Yeah.
the exact numbers. And then when the asset sells, you're making up the remaining
That's
5
right.
to 6%, and then everything past that gets split between the limited partners, and I assume the general partners.
Yes,
you didn't mention
absolutely.
the general
No,
partners.
absolutely. Oh, sure.
You're not doing this for tips.
No. So in terms of the LP stack, so going to that 6 million that we brought in from LPs. So part of that is as a company, our philosophy is we invest alongside the LPs. So we put our own capital into that class of shares as well, so that we're treated the same. Yes, there is a promote, and on this particular deal, the way it was structured is our LPs get an 8% preferred return and then a 70-30 split. Not to complicate it too much, but one of the LPs was also a fund that we had recently launched. So we were bringing in capital from our fund as well. So we had sort of two sources of capital that sort of came together to fill up that 6 million bucket.
Awesome. All right. That is, it's not as overly complicated equity stack, but we haven't really discussed equity recently on the podcast. So thank you for going into that. So what kind of fees did you charge to the deal? Like acquisition, asset management, capital event?
Yep. So we like to keep it pretty light on the fees. Again, going back to our philosophy of in many of our deals, we're like the largest investor ourselves. So it doesn't make sense to just charge fees. And we'd rather make our money alongside our investors, right? So we try to align it from that sense. So yeah, there is a small acquisition fee. It was either 1.5 or 2% acquisition on this particular deal. And then in terms of one-time fees, that's it. We don't charge a financing fee or a refinancing fee or a disposition fee. It's just an acquisition fee. And then there is, on an ongoing basis, there's a asset management fee of 1.5% of the revenue that comes in to the property, but which really doesn't equate to a lot if you run the numbers. Barely covers us part of a person, but that's it. So if you ask me, I think it's a fairly light fee structure, and our model is we like to give good returns to our investors, and hopefully they come back to us and reinvest with us, and through that we sort of grow the pot, right? And then if we do well, we hit our targets, then there's that promote. And in this particular deal, there was that 70-30 split. In our fund, we actually make we have an 80-20 split, so we give even more money to our investors.
Very interesting. Thank you for going over all that. Well, in wrapping up, Percy, what did you find easy during this process that you thought was going to be more difficult? And then we can also flip that question on its head. What did you find that was harder that you expected to be easier?
Right. So one of the things, this was a relatively new asset class for us, the build to rent. Even though it's not as much of a stretch for multifamily, it is new. So we sort of had to explain what that means and show that there is a need for this type of housing. So there was a little bit of an education with our existing investors, but that seemed to be pretty well, they accepted it fairly well, and that was relatively easy. In terms of what was more challenging was the timing of this project, right? And I said, with the capital markets a bit in flux, and even from an investment standpoint, a lot of investors at that time, just hearing all that stuff on the news, they just decided to maybe be a little more conservative and be on the sidelines. So raising the capital was a little bit of a challenge, even though this is probably on the smaller side for us in terms of the capital that we raise. That was a little bit of well, I wouldn't say too much of a challenge, but it was a little bit of a challenge in terms of in the past we would have been able to raise that, let's say, in 30 days. Over here it took us 60 days. So that was a little more challenging. But overall, knock on wood, I think we got a good deal, and we like this, and we have a good outlook for the outcome of this project.
Awesome. Well, Percy, thank you so much for sharing your knowledge and experience with us here today. If listeners want to find out more about you, how can they do so?
Well, they can connect with us at penncapitalgroup.com. That's PENNCAPITAL group.com, or reach out to me on LinkedIn. I think if you search for Percy Nikora, you might only find one person there. So look forward to connecting with your viewers. And like I said, I've been a fan for a long time. So thank you for having me on the show.
Absolutely. Well, Percy, again, thank you for sharing your time with us here today. We look forward to hearing about your future deals.
Thank you, Whitney.